Welcome to the Deep Dive. Today we're jumping into something that, let's be honest, can feel pretty intimidating, but it's just so vital for building wealth. We're talking about the stock market.
That's right.
You've shared some great foundational stuff with us, and our goal today is to really cut through the jargon, find those key insights for you, the listener.
Exactly.
Give you that shortcut to understanding what makes it tick, maybe bust a few myths along the way.
Absolutely. People see the stock market as this black box, but really it boils down to ownership and potential growth.
Right.
Getting these basics down, like we'll cover today, is really the first step to feeling, well, more confident about your money decisions. We'll unpack what stocks are, sure, but also why they move and what that means for you and your, long-term plans.
Okay, let's do it. So right at the start,
Mhm.
a stock. What is it, really? When you buy one, what have you actually got in your hands, so to speak?
Good question. So a stock, or you might hear it called equity, it literally means you own a tiny piece of that company, a share of it, like a real slice of the pie.
Exactly. Think of it like this. If a company has, say, 1,000,000 shares out there, and you buy 1,000 shares, you own 0.1% of that entire company.
Okay.
And owning that piece gives you basically two main ways you might benefit.
Right.
First, price appreciation. If the company does well, grows, becomes more valuable, its stock price usually goes up. Simple enough. Then you can sell your shares later for a profit.
Makes sense. And the second way?
Dividends. Some companies, often more established ones, choose to pay out a part of their profits directly to their shareholders, maybe quarterly or annually.
Like getting a little check in the mail, or, well, digitally now.
Pretty much. But it's important to note not all stocks pay dividends. Lots of, say, tech companies or faster-growing businesses, they often prefer to reinvest all their profits back into the company.
To fuel more growth.
Exactly, hoping for even bigger price appreciation down the road for you. So it tells you something about the company's strategy, income now versus potentially more growth later. Gotcha. So if a stock is a piece of a company, then what's the stock market? It doesn't sound like one single building anymore.
No, definitely not. That's a common image, but it's really a huge network, a collection of markets and exchanges all designed to make buying and selling these shares easy.
Like the New York Stock Exchange, NASDAQ,
Yeah.
those names we hear.
Precisely. Those are major hubs, mostly electronic now, where buyers meet sellers. And when you hear things like, the market was up today, they usually mean an index.
The index.
Yeah, like the S&P 500. It tracks a big basket of stocks, like 500 large U.S. companies. So it gives you a general sense of how things are going overall.
Like a market temperature reading.
Good way to put it. And fundamentally, prices move based on supply and demand. What are buyers willing to pay? What are sellers willing to accept? That's the core mechanism.
Okay. And there's something about when a company first offers shares versus when you and I trade them later, right? A difference there.
Yes, a key distinction. There's what we call the primary market. That's where a company sells shares directly to the public for the very first time. It's called an IPO, an initial public offering.
Right. IPOs. Hear about those.
That's the company raising capital. Then, after that, those shares start trading between investors. That happens in the secondary market.
And that's the stock market most of us interact with.
Exactly. When you buy or sell shares through your online broker, you're almost always in that secondary market, trading with another investor, not the company itself.
Okay. That clears things up. Now, let's get to maybe the most interesting part for people thinking long-term, the growth potential. The sources we looked at really highlight this. Stocks have historically done better than, well, most other things over time.
Yeah, the historical data is pretty compelling. If you look at the U.S. stock market, using that S&P 500 index as a proxy, the average annual return over the last century or so has been around 10%.
10% a year, on average. Wow.
On average, yeah. And that includes all the ups and downs. Even if you adjust for inflation, you're looking at something like 7% real growth per year.
That really adds up over time with compounding.
It really does. And get this. The market has actually finished the year up in roughly 70% of the year since the 1920s. So despite the bumps, the overall trend has been strongly positive.
Okay, that long-term upward trend is why it's pushed for wealth building.
Precisely. It's the engine for long-term growth for many people's savings.
And there's always a but, isn't there? That kind of potential doesn't come free. The sources definitely talk about risk, volatility. What does that actually feel like for an investor?
Right, that's the other side of the coin, and it's absolutely crucial to understand. Unlike, say, a savings account where the balance just ticks up slowly, stocks bounce around. A lot.
Daily ups and downs.
Daily, sometimes significantly.
Yeah.
And bigger swings are normal too. A drop of 10% from a high, that's called a correction, happens pretty regularly.
And bigger drops.
A 20% drop, that gets labeled a bear market. And we've seen major crashes too, things like the 2008 financial crisis or that super sharp drop in early 2020 when COVID hit. Those can be scary.
So it really raises the question, how do you deal with that? Knowing it can grow, but also knowing it can plunge.
It's the central challenge, isn't it?
So, yeah, point blank, you can actually lose money.
Oh, absolutely. Yes. Investing in stocks always carries the risk of loss, especially if you need the money soon. A specific company could do badly, its stock could fall, it could even go to zero if the company goes bankrupt.
Okay, that's the scary part.
It is. But historically, these downturns, these bear markets, they've always been followed by recovery and eventually new highs. And the periods of rising prices, the bull markets, they tend to last much longer, and the gains tend to be much bigger than the losses during the downturns.
So over the long haul, the ups have outweighed the downs.
Historically, yes. But it requires patience, and that risk is exactly why diversification is so important.
Diversification.
Meaning, don't put all your money in just one stock, own many different ones. Or, even easier, invest through funds that hold hundreds or thousands of stocks. That way, if one company has problems, it doesn't sink your whole portfolio.
Okay, spread the risk
Mm-hmm.
and have a long-term view.
That's the key. Which brings us to how someone should approach this, especially if they're just starting out.
Yeah, what's the takeaway for a beginner? The sources hammered this long-term perspective idea. Why is that so critical?
It's probably the single most important concept for a new investor. Basically, any money you think you'll need in the short term, say the next year or two, maybe even 5 years, for something really important like a house down payment, that money probably shouldn't be in stock.
Because it could drop right when you need it.
Exactly. The volatility means you might be forced to sell at a loss if you need the cash suddenly. But money you can leave invested for longer periods, 5, 10, 20 years or more, that's where you can really let the market's potential growth work for you.
The short-term bumps smooth out over longer timelines.
That's the historical pattern. Think about it. Someone who invested, say, 20 years ago, they went through the 2008 crash, the 2020 crash. Scary times. But if they held on through a broad market fund, they'd likely be way up today.
So those huge drops look more like blips on a long-term chart.
In hindsight, yes. They feel terrible at the time, but they've historically been temporary setbacks on a much longer upward path.
Which means the big challenge is resisting the urge to sell when things look bad. Avoid panic selling.
You nailed it. It's easy to say stay the course when everything's going up. Much harder when your balance is dropping fast and the headlines are screaming crisis.
Your gut tells you to get out.
Right. But history shows the market has recovered from every single crash, every single one. Staying invested, sometimes even adding more money when prices are lower, and that's often been the winning strategy for long-term goals.
It's fascinating that sometimes the best move is to do nothing. Just wait it out.
It really is. Patience and consistency often beat trying to perfectly time the market jumping in and out. Almost nobody gets that right consistently, not even the pros.
Okay, so for someone who's listening and thinking, all right, I get the long-term idea, I'm ready to start, what's the practical first step? How do you actually do it?
The good news is it's never been easier, really. You mostly just need an internet connection. The main thing you need is a brokerage account.
Like opening a bank account.
Pretty similar process, yeah. Lots of online brokers let you open an account easily, often with no minimum deposit. And importantly, many now offer 0 commissions for trading U.S. stocks.
So it doesn't cost much just to get started.
Right. Lowers the barrier significantly. You'll provide some personal info, link a bank account to transfer funds, and you're basically ready.
And what about retirement accounts, like IRAs or 401ks?
Those are great vehicles for stock investing because they offer tax advantages. An IRA you open yourself, a 401k is usually through your employer. Both let your investments grow, potentially tax-deferred or tax-free, which is a huge boost over time.
Okay, so open an account. Then what? Just pick some stocks.
You could, but for most beginners especially, trying to pick individual winning stocks is really tough and risky. A much more common recommendation is to start with index funds or ETFs.
We mentioned index funds earlier. ETFs are similar.
Yeah, exchange-traded funds, ETFs, both are Types of funds that hold a whole bunch of different stocks, often tracking a specific index like the S&P 500.
So you get that diversification automatically.
Instantly, you buy one share of the fund and you effectively own tiny pieces of all the companies in that fund. It dramatically reduces the risk compared to putting all your money on just one or two companies. It's
Yeah.
a simple, low-cost way to get broad market exposure.
Makes a lot of sense for starting out. Keeps it simpler.
Definitely. Start broad, learn as you go.
Okay, so let's try and wrap this up. The stock market. It clearly offers the best shot at significant growth for your money over the long term, historically speaking.
Right. Highest potential rewards often come with it.
And it's a but it absolutely comes with real risk, lots of ups and downs, especially in the short term. You have to be prepared for that volatility.
Non-negotiable part of the deal.
So the key for you, the listener, seems to be really understanding that trade-off. Accepting those sometimes scary downturns is the price you pay for the chance at much larger long-term gains.
Well put.
And the way to manage that risk is through diversification. Don't put all your eggs in one basket. And crucially, focusing on the long term, thinking in terms of years or even decades, not days or months.
Exactly. If you can do that, you can harness the market as this really powerful engine for building wealth over your lifetime.
Start slow, maybe with those broad index funds or ETFs. Keep learning.
Couldn't agree more. And, it leads to a really interesting question for you to think about personally.
Oh, yeah?
Knowing what we've discussed, knowing that historically the market has always recovered from crashes, how might that knowledge, really internalizing that long-term resilience, change how you react the next time you see those scary headlines about a market dip?
Does it become a moment of panic or maybe something else?
Something to consider.
That is a great thought to leave everyone with. Thank you so much for walking us through these foundations today.
My pleasure.
We hope this deep dive has left you feeling a bit clearer, maybe a bit less intimidated, and hopefully empowered to think about your own financial future. Thanks for joining us.